Well, good Wednesday to you, traders. Today is Wednesday, September the 16th, 2020, and we've got a new trading idea for you to take a look at today. Very interesting trade idea for you today. We've done this for you past subscribers, you old subscribers that have been around for a while. You have seen this trade before. It's a little bit more complicated than what we're generally used to doing, but I think if we understand the steps involved, it will sort of fall into line logistically, and you'll be able to understand sort of the premise behind it. And we're going to get into that here, but I just want to review real quickly our current positions because we do have a lot of positions open, just relative to what we're usually used to in our model portfolio. We usually have maybe 3 to 5 positions. We've got 6 positions open right now. So our BA positions are solid once again, guys. This is the trade that just keeps on giving. We do have, as you know, 2 overlay Iron Condors simultaneously running here. Those are set to expire this Friday. And right now, no action is needed there. Those both look really solid moving forward. Our CRM trade, pleasant surprise. We were able to get a put leg. I honestly did not think we were going to get a put leg in on that trade, but we were able to do so. And that has shaped up to be a really, really solid trade. Really nice trade. And the rate of return now with the put leg in there is astronomical. It's through the roof on that. Our EEM trade is pushing up on that 45 level again, and so we're going to continue to watch that. A couple of the advantages that we have on the EEM trade right now, even though it is pushing up on that 45 strike call leg, we're still in the profit zone because of the premium that we brought in on that trade. And that gives us a lot of flexibility here going into the weekend, going into Thursday and Friday prior to expiration. In terms of being able to adjust it, we could actually adjust it right now at a credit, actually bring in more money income-wise on the trade without even having to put up any additional capital. And so we'll continue to watch that, but just make a note that if we do need to make an adjustment on Thursday, of course, I will give you a heads up on that. I'll send you an alert for that. Our IWM trade continuing to be really, really solid. IWM is another indices. I've mentioned this in the past here, a couple of weeks, I believe, that right now in the marketplace, indices are a very favored trading vehicle. They've always had a lot of distinct advantages over trading individual stocks in terms of risk management, but in terms of return, they've been very deficient. Well, IV, implied volatility, is high in the marketplace now. That's helping the indices. And so IWM, I would just make a note of that as well. That's probably something that we're going to be coming back to the well on in the future also. Our SPG trade. Our SPG trade is kicking butt right now. We'll get into this a little bit more over the weekend in terms of kind of the J.C. Penney acquisition, and I think that the marketplace has really taken. I think they fully understand it now, and I think that we'll talk as we talk about the numbers in the weekend update. You'll see the power of it as well. But that's powering higher, and we're right where we want to be going into expiration here, right just above that $70 level, which would be our max profit on our synthetic covered call portion of the trade, which was our 60 leap and our covered call, our short-term call that's expiring this Friday, which is the 70 strike price. And so we'll talk about some of the options that we have there to enhance that trade going forward here. We have several options on the table here, and one of them is going to be better than the other, but right now they all look pretty darn good. So bringing in a lot of profit. I don't know if I'd have to look at the numbers. I haven't run the numbers this morning yet on that. We may be getting very, very close to the profit zone on our overall SPG's positions. But we'll take a look at that here also in the weekend update. And then our Tesla position. Tesla's doing what Tesla does, and it's bouncing around, but it is bouncing in the green zone. That's an expiration not this week, for next. And so we just need a little bit more of that extrinsic value to come out of there. And we should hopefully be able to book our nice solid profit on that. And again, it's a nice trade in terms of saying, you know, what most people are scared of, which is the unknown and crazy moves and volatility, and it could be up, it could be down. That's what we're looking for. That's what we hope for. So pretty much all of our positions right now are pretty solid going into expiration weekend. We're keeping an eye, obviously, on EEM, and we will let you know tomorrow if we need to make an adjustment on that. But our trade for today is on Bank of America. And this is an interesting trade, folks. This is a trade that we have done in the past, successfully, I might note. And we're going to look at doing it again here today. If you look at BAC, you can see that it is really trending nicely in terms of an Iron Condor. But the problem that it takes place with Bank of America, if we go to trade this, and just a note here on BAC, we do have earnings coming out on October the 21st. And so we're going to go ahead just in front of that, and we're going to trade these October 16th options. This is a 30-day expiration trade. And, you know, we could just put on an Iron Condor, right? We could go look at a standard Iron Condor. I think we're looking at maybe some wings like, let's try the 23s, and maybe up here. Let's go something like this. And if we looked at that in a risk graph, you guys are familiar with that. That is a very standard looking Iron Condor. The problem that we have with Bank of America is if you look at it in a chart, if you look at it chart wise, that makes pretty good sense in terms of pricing. Well, we would be putting a put leg in here down around 23. That's right in here. Well, that seems to coincide quite nicely with some support levels down here previously. Pretty decent amount of distance away from the current price. On the call side, if we're doing a 28, that's up in here, and that's above the previous high that we hit right here. So that seems reasonable as well. But yet, when you look at the trade, you can see it's only a 60% probability trade. And that is because Bank of America can sit for a really long time. Look at the candle size. Look at the sizes of the candles of Bank of America. They're very, very small candles. Bank of America only has about a 60 or a 70 cent, 67 cents right now, ATR, average true range. That's a measure of the average daily movement of that stock. Guys, that's not very much because that's counting both up and down ranges. So that means that this stock doesn't move a lot. Those are very, very tiny candles, but yet the distance that it can move is pretty substantial. We can go from 1980 to 25 bucks. We can go from 25 bucks down to 20 bucks in a very short period of time. So it sort of has, in some instances, the best of all worlds in that it's got a really nice looking chart to overlay an Iron Condor on, but at the same time, the movement of that stock makes it a little difficult to get really, really high probabilities. And so one of the things that we've done in the past is we have done what's called a Dragonfly. Now, a Dragonfly is very similar to an Iron Condor. In fact, I'm going to tell you right now, this is going to be the first part of the Dragonfly that we're going to put together right here. Is we're just going to do a standard Iron Condor, just like you see right here. But the Dragonfly adds some additional protective legs inside of this green zone. This box right here that you see that is our profit zone, we're going to add some protective wings, both up here on the call side and down here on the put side, that is going to give us a little extra insurance protection on this trade. Now, folks, insurance is insurance, whether we're talking car insurance, home insurance, or stock market insurance. Insurance all works the same. It costs us money. And so we are going to give back a little bit of what we initially make on this Iron Condor to subsidize or pay for the insurance. But the bottom line is, what is the net on the trade? So we're going to bring in a pretty nice, decent gross rate of return here, credit, if you will, on this trade by putting this Iron Condor together. And we're going to take a little bit of it and we're going to spend it on some extra insurance in this trade. So this is step one right here. I'm going to look at doing on this trade, I'm going to look somewhere around, let me de-emphasize this so we can get the pricing correct. I'm going to look somewhere around, now I'm all messed up. Let me bring my quantity back in line here. Okay. I want to try to get this up. Let's try 8 contracts and see 8 contracts, 9 contracts. I'm going to maybe shoot for 9 contracts for me. Now, this ratio here is going to be about 8 or 10 to 1, 8 or 10 to 1. So the more contracts you do here, if you go above 10 contracts, I wouldn't recommend that because that's about the limit that you want to do on our insurance. In other words, for every 9 contracts in my example, I'm going to buy 1 contract of insurance. So if you wanted to go higher than this, if you wanted to go more than this, you want to probably keep it in those increments. I would go to 18 of these contracts. So I would increase this amount by 9 contracts a time because it's going to be a 9 to 1 ratio in my instance here. So I'm going to look at this at about a 50, mid price is 54-cent credit. Nat price is 51 cents. Bank of America usually prices pretty well on its spreads. And so you can see here again what I'm looking at. This is the October 16th expiration date options that we are looking at trading. This is a 30-day window that we're trading. And on the put side, I'm selling these 23 strike price puts and I'm buying the 21s. On the call side, I am selling these 27 strike price calls and buying the 29s. Again, nat price is about 52 cents, mid price showing 54. I'm going to try to get that 54, see what we can get. Whoops, I need to change my account. Let's get into the right account size here. Here we go. And let's see what we get pricing wise. Okay, so we're working here at that 54. I know we're close. I'm going to replace that order and drop it 1 penny to 53. It's still showing us a couple points above where the nat price is. Let's look at that nat price again. 52 is the nat price. I'm trying to get 53 on that. Generally speaking, if I didn't need to get a video out to you guys, I'd probably let that sit for 15, 20 minutes, but I'm just going to go down to the nat price. So that's going to bring in, I want to make some numbers. I want to make note of these numbers here. You can see that that's going to bring in for me about $427 on about almost $1,400. Let's call it $1,400 there. Okay, so I'm going to send that order, and I do get filled at that 52 cents. So this is step 1 of the Dragonfly trade on Bank of America. We're going to put this Iron Condor together. Okay, so here's the Iron Condor that we're looking at. Right here. We are using the October 16th expiration date. It's 30 days to expiration. Selling 9 of these 23 strike price puts, buying 9 of the 21s. Selling 9 of the 27 strike price calls and buying 9 of the 29. So now, if we look at this in the curve, we have our Iron Condor. What we want to do now is we want to take some of that $427 and we're going to utilize that to buy some insurance up here on this side of the wing and down here on this side of the wing. So let's take a look at that real quickly. Okay, we're going to come back here to our table. We're still using these October 16th expiration date options. And I'm going to come in here and I'm going to purchase 1 contract of this 24 strike price put. So 1 contract, and it is a buy. It is a purchase. So this is when I talk about a 9 to 1 ratio. You can see our, let me just remove this here for a second. You can see our current position sitting here now. Here's the put leg that we sold. Here's the call leg that we sold. I'm going to now purchase 1 of these 24 strike price puts. Okay, it's about 58 bucks is what that's going to cost me. I'm also going to simultaneously purchase 1 of these 26 strike price calls, and that's going to cost me about $83. Okay, so we're spending, we're spending roughly $140. We brought in $427. I'm going to spend about $140 of that. That still gives us about $290 or something like that profit potential on a $1,400 investment. That's a great rate of return. And if we look at this now in the curve, take a look at that now. Now we have a little bit of a kicker there. Now if we start to push towards these wings, we have a little bit of extra insurance in place there helping us with this trade. So I'm going to go ahead and I'm going to just send this order right here. And let's see where we're at pricing wise on this. I'm looking close. Let's try 140. I do get filled at 140. Okay, so there's our trade, and again, that's a nice looking risk graph right there, guys. So that's our trade. Let's look at the activity once again. It is a two-part trade. Once again, you're going to start with the Iron Condor right down here. We're going to sell 9 of these October 16th expiration date contracts, selling the 23 strike puts, buying the 21s. On the call side, we're selling the 27s, buying the 29s. Once we get that Iron Condor in place, we can use some of this income that we brought in to purchase one of the 24 strike puts and one of the 26 strike calls. So guys, there's your trade for today. If there's any alerts, if there's any additional activity that we need to do, obviously you're going to hear from me tomorrow on that. So have a great trading day, and we'll talk to you guys really, really soon.